Hey everyone, let's talk about something that literally makes the world go round: money. Whether you're buying coffee, paying rent, or just saving for that next big trip, money is at the heart of nearly every economic interaction. But what exactly is money? And why is it so crucial to our economy? At its core, money is the most widely used means of exchange. It's basically an economic unit, usually coins, bills, or digital entries, that everyone accepts for goods and services in a transactional economy. The real magic of money is that it lowers transaction costs, especially what's called the double coincidence of wants. Ever tried to swap your sandwich for someone's apple, only to discover they don't like sandwiches? That's the double coincidence of wants, and money solves it. If you're alone on an island, sorry, no economy, no exchange, no need for money. So what does money actually do? Economists break this down into primary and secondary functions. First, the primary functions: it's a mode of exchange. Whenever I buy something, I use money. Simple. It's a common measure of value. Everything gets priced in the same units. Now the secondary functions. Money stores value. I can save money today and spend it next week, next year, or even in a decade. It transfers value. I can send money across town or across the world, and it still means something. It's a standard for deferred payments. I can borrow today and pay back later thanks to money's consistency. But before money, there was the barter system. Imagine a world where you had to trade goods for goods, wheat for cloth, or a house for horses. That's a CC economy, commodity for commodity. Sounds simple? Not really. Barter came with some serious drawbacks. No common measure of value. How much wheat equals a shirt? No double coincidence of wants. You want my wheat, but I don't want your shoes. No standard for future payments. No way to store value that doesn't spoil. Lacking divisibility. How do you split a cow for change? And try exchanging services. Can you pay your dentist with vegetables? Awkward. That's why money was such a game changer. Now let's talk about the demand for money. Think of it as your liquidity preference, how much cash you want to hold instead of investing it or spending it. Why do people demand money? Two main reasons: transaction motive and speculative motive. The transaction motive is simple. I need money to buy stuff. As my income goes up, I need more money for all those transactions. The speculative motive is about opportunity. Sometimes it's safer to hold on to cash instead of investing it, especially if you're waiting for a better deal or you think the economy's going to get rocky. So, in an economy, the total demand for money is the sum of transaction demand and speculative demand. Economists write it like this: MD equals sign MDT plus MDS, where MD is money demand, MDT is transaction demand, and MDS is speculative demand. And what about the money itself? Most of what we use today is fiat money. That means it has value because the government says so, not because it's backed by gold or silver. Its worth is all about supply and demand, not the stuff it's made from. Last but not least, the supply of money. This is the total stock of money, coins, bills, and what's in your bank account that's actually being used by the public at any given time. It doesn't include cash held by the government or banks. Economists use measures like M1, M2, M3, and M4 to keep track. M1 is currency plus demand deposits and other deposits. M2 adds post office savings. M3 throws in time deposits at commercial banks. M4, that's M3 plus almost all post office deposits. So, the next time you pull out your wallet or check your balance, remember, money isn't just numbers or paper, it's the grease that keeps the world's economic gears turning. Keep that in mind and you'll ace your next economics exam. Catch you next time.
Let's talk about banks. These institutions play a vital role in our financial lives, and understanding them is key to managing your money effectively. Banks. Those places you trust with your money but rarely think about the intricate systems that keep it all running smoothly. They're a cornerstone of modern society. Imagine getting paid in cash, a tangible reward for your hard work, and then realizing you have nowhere safe and reliable to keep it. Risky, right? The thought of losing it or having it stolen is a constant worry. That's precisely why banks exist. They offer a secure haven for your hard-earned money. Their primary function is to keep your money secure, protected from theft and loss, giving you peace of mind. But they do more than just store cash in a vault. They offer a wide array of financial services. Banks make your money accessible whenever and wherever you need it. They provide convenient tools like debit cards, allowing you to make purchases with ease. They facilitate online payments, enabling you to manage your finances from the comfort of your home. And ATMs, giving you access to cash around the clock. They're not just vaults filled with money. They're the backbone of our economy, the engine that drives financial growth. Banks are responsible for moving money where it's needed, facilitating transactions across the globe. Without banks, getting a loan to start a business or paying bills online would be a logistical nightmare, if not impossible. Banks connect savers and spenders, channeling funds from those who have surplus to those who need capital. This connection fuels businesses, supports innovation, and helps individuals achieve their personal financial goals. They're the middlemen of money, the facilitators of countless financial interactions. Banks are essential for making daily life and the entire economy run smoothly, ensuring that funds flow efficiently, whether you're diligently saving for a dream vacation or simply buying a burrito for lunch. You're directly or indirectly using this complex and vital system that banks provide. Understanding the role and function of banks is the first crucial step to making them work effectively for you and your financial well-being. So, let's dive in and explore the inner workings. Let's see how this intricate system really operates, from deposits to loans and everything in between. Because banks are way more than just a safe for your cash, they are a dynamic force in the world of finance. Most of us use commercial banks. Think Chase, Bank of America, or your local credit union. Their main job: take deposits, make loans, and connect people who have money with those who need it. They profit from the difference between what they pay savers and what they charge borrowers. But they're more than that. Banks offer credit cards, online banking, and even safe deposit boxes. The more services you use, the more likely you are to stick around, and the more money they make from fees. Your bank is a one-stop shop for saving, borrowing, paying, and planning your financial future. In the intricate world of finance, commercial banks play a vital role. They are the familiar faces we interact with daily, offering services like loans, savings accounts, and facilitating transactions. If commercial banks are the players on the field, then the central bank is the referee, ensuring fair play and stability. It sets the rules of the game and watches closely to prevent any fouls. In the US, this crucial role is fulfilled by the Federal Reserve, often simply called the Fed. It stands as the guardian of the American financial system. And in India, the responsibility falls upon the Reserve Bank of India, or RBI, a cornerstone of the nation's economy. The central bank has several key functions. First and foremost, it issues currency, ensuring there's enough money in circulation to meet the needs of the economy. It also manages the government's money, acting as its fiscal agent and overseeing its accounts. Furthermore, it acts as a bank for other banks, providing them with services and a place to deposit their own funds. It settles debts between banks, ensuring smooth and efficient transactions within the financial system. And perhaps most importantly, it steps in during crises as the lender of last resort, providing emergency funding to banks to prevent a collapse of the financial system. Most importantly, it controls the nation's money supply, influencing the amount of money and credit available in the economy. And it sets monetary policy, making decisions about interest rates and other tools to influence economic activity. By adjusting interest rates and other tools, such as reserve requirements, it keeps inflation, the rate at which prices are rising, and unemployment, the percentage of people who are out of work, in check. Think of the central bank as the driver of the economic car, sometimes braking to slow down an overheating economy, sometimes accelerating to boost growth during a downturn. Its decisions shape the entire financial system, influencing everything from interest rates on mortgages to the availability of credit for businesses. That's why it's one of the most powerful institutions in any country, wielding significant influence over the economic well-being of its citizens. Now here's where things get really interesting, almost like a magic trick, but with real-world implications, because most money isn't physically printed by the government. Instead, it's created digitally by banks when they approve and make loans. It's a process that might seem a little abstract at first, but it's fundamental to how our modern economy functions. This system is called fractional reserve banking, and it's the cornerstone of modern monetary policy. Imagine you deposit $1,000 into your bank account. The bank is required to keep a fraction of that deposit in reserve, let's say 10%, and then it can lend out the remaining amount. That loan, once disbursed, becomes a new deposit in someone else's account somewhere else in the banking system. And then the cycle repeats itself, creating a ripple effect throughout the economy. Each time this happens, more money is effectively created in the economy. All of this occurs without the need for printing a single physical bill. This phenomenon is known as the money multiplier effect. In essence, banks have the power to expand the money supply simply through their lending activities. Your initial deposit sets off a chain reaction that leads to loans being issued, and those loans in turn generate even more deposits throughout the system, and so on, creating a continuous cycle of money creation. This process is fundamental to how banks fuel economic growth and expansion. However, this also means that the system requires careful oversight and regulation to prevent instability, and that's precisely where the central bank steps in to play its crucial role. So let's delve deeper and see how they work to keep things balanced and maintain financial stability. With banks creating money, the central bank uses powerful tools to keep things in check. It can raise reserve requirements, making banks hold more cash and lend less, slowing money creation. It adjusts policy rates like the repo rate. Higher rates mean more expensive loans, cooling the economy. The reverse repo rate encourages banks to park money with the central bank, tightening the money supply. Open market operations, buying or selling government bonds, inject or drain money from the system. These levers control inflation, borrowing, and spending. The central bank's decisions affect your loans, job prospects, and the economy's stability. That's why understanding this system matters for everyone.